Good morning. We're going to talk about bubbles. We could call this asset bubbles because it's uh, it's always relative to some asset or some asset class. Uh, this is just a brief video, and to give you an overview, you also have a number of links to articles to give you a more detailed version, but at least this will give you a basic idea of what's going on. There are five stages to a bubble. Number one, what's called displacement. Something changes or there's a new paradigm. Uh, uh, Something that's happened in the last 10 to 15 years. We have very, very low interest rates. That's definitely a change. Interest rates are close to zero, historic lows, uh, and that's caused certain asset classes to increase in price quite a bit. Whether it's a bubble, that's a good question. So we have some sort of change that happens. Second of all, we have a boom as a result of that. Asset prices gain momentum. It may take a while, but it might take a year to 5 years, but eventually prices start to really get on the move. Stage three is what's called euphoria. People find a money tree. And suddenly people realize that they're making 20, 30, 40% per year or higher. And they think they've found uh, the key to success. They found a way of investing where they can quit their job and just let the money work for themselves. And there's a euphoria surrounding it. And the news cycle tends to buy into this actually. So, and it creates a lot more exuberance. Uh, So that can only go so long. When people are euphoric, they do stupid things like they'll borrow money to invest in the stock market. It's called leveraging. Uh, and of course, at this point, people are convinced that they can't lose. Uh, and then eventually, profit taking. There are a lot of people invested in these asset classes that actually understand long-term investing, and certain disciplined people will get out. If they make a lot of money, eventually they realize it's time to get out. And of course, what happens is this money tree withers a little bit. And then, of course, once we're over the hump, the intelligent people get out. The greedy people are all that's left. And maybe if if they're very heavily leveraged uh, to turn their thousands into millions, suddenly they panic and they've got to cover their loans or whatever. So they all of a sudden everybody rushes for the door. Imagine 10,000 people in a big auditorium. Everybody wants to get out instantly. What happens is only a few get out. The rest of them lose their shirts. That's a natural cycle of every asset bubble. Uh, if you're a long-term investor, it's good to take this into account. Here are some interesting examples. What's called the Dutch tulip bubble of 1634 to 1637. Tulips were a new thing introduced in the 1500s to Holland. Uh, and supposedly, certain tulips that were rarities were going for hundreds of thousands of dollars. It sounds ridiculous, but the price of tulip bulbs actually uh, the right the right seeds nowadays could go for a lot of money, but in that case, it was more than just something having intrinsic value. The value of tulip bulbs were escalating, and everybody and their brother were investing in them, and of course it crashed. The South Seas bubble of 1720, that was in London. The South Seas Company, it was a shipping company. They literally had ships that sailed the seas, and uh, there was huge markets were going to open up, and of course, people invested in the South Seas Company. Everybody and their brother, members of parliament, members of the clergy, and of course, the value of the stock went up eightfold in 1 year. So people made a lot of money. Maybe they put 10,000 in, suddenly they had 80,000. Uh, or if they borrowed money, you borrow money and then uh, increase your investment eightfold, pay off the loan, suddenly you have money that appeared out of nowhere. And of course, that caused a frenzy. Supposedly in London, people were selling their furniture, selling whatever they had just to put their last dollar into this investment. Of course, it crashed. Eventually, it crashed. The company was a company, but it was nowhere worth what the value of the stock increased to. I actually read about the South Seas bubble when I was in London several years ago, and one interesting effect is in 1721 the consumption of gin in London doubled. Of course, people committed suicide, and to actually they self-medicated basically by drinking. At that time in London, 25% of all buildings in London were involved in either manufacturing or serving gin. It was basically a city of drunks. Well, in 1721, it became an even bigger city of drunks. And we went from 1720 euphoria, couldn't lose, everybody's making money. 1721, many people were poorer than they were before they started. So. Stock market crash in 1929. The 1920s were called the Roaring Twenties. People were heavily investing in the stock market. Banks started investing in the stock market, which was unusual. The model for savings and loans going back many years was you pay people that deposit their money, you pay them 4%. People that borrow money, you charge them 6%. And people in the neighborhood put all their money in the bank and they loan that out to people that have mortgages that buy homes. That 2% difference is what you use to pay the bank manager and the tellers and keep up the building, et cetera, et cetera. In the 1920s, banks got away from that model and decided, well, they could make a lot more money instead of loaning money out by way of mortgages and charging 6% interest. They could invest in the stock market and earn 20, 30, 40%. The stock market was roaring. It was a good model as long as it worked, because suddenly the bank managers had all sorts of money. They probably bought bigger houses, made all sorts of stupid investments, paid themselves big raises, et cetera, et cetera. But eventually that all came to an end. We reached got down here to the fourth and fifth stage. The stock market collapsed. It went down precipitously. And of course, a lot of these banks suddenly had no assets. Instead of having depositors' money that they were lending out, suddenly they had no assets. And there was a run on banks, and a lot of banks closed. So honest people who deposited their money, farmers, laborers that worked per hour, very painstakingly to earn money, suddenly that money was gone. The banks just had to say, sorry, the money's gone, we can't do anything about it. There was no such thing as government insurance at that time. One result of the stock market crash in 1929 is what was called the Glass-Steagall Act that regulated banks. And second of all, the Federal Deposit Insurance Company came in and insured bank accounts. They had to do that to get people to invest in banks again. People were hiding money in a mattress. My grandfather lost a lot of money in the stock market crash in 1929. Didn't put any money in banks until the 60s. And I knew people that, actually I knew a lady whose brother had all his money buried in fruit jars. This is in the 80s. In the 80s, actually, he had all his money buried in fruit jars out on his farm because he still didn't trust banks. So the Glass-Steagall Act was repealed in the 90s, actually. One of the things that led to this housing bubble in 2007, which caused the stock market to crash in 2007, 2008. In the late 90s, the housing market was deregulated. Prior to the 90s, to get a mortgage, you had to verify income, and they changed that to verified income to stated income. You could basically state your income, and they believed you. Of course, then anybody could borrow. People with $20,000 in income were buying $500,000 homes with the hope that the house was going to appreciate. They were going to flip it and then make money. And so the housing assets prices went higher and higher and higher. Eventually, that went belly up. Part of it was adjustable rate mortgages came out, and you could get a very low rate for 5 years, and after 5 years it would go up, and that helped people qualify for even bigger mortgages. Well, eventually, when a lot of these mortgages came to that 5-year window, more and more people couldn't cover their bets, so to speak, and then the whole housing market collapsed. The dot-com bubble of 2000, the internet became very popular in the mid-90s, and very little commerce on the internet, but people knew it was going to be big, and so people were investing crazy money in any kind of internet company, no matter what they sold, and of course, average people were becoming millionaires overnight by investing in dot-com companies. The prices were going through the roof. And of course, there was a lot of euphoria on the news networks. A lot of the tech companies, the regular tech companies we think of today, Microsoft was actually doing very, very well. IBM was doing well, but there were a lot of smaller companies where their stock prices were doubling over very short time periods. It could be a month, could be 2 months, and of course, if people were invested in the right fund, they were tripling, quadrupling their money in a year, and people were developing an astounding amount of wealth. My wife's uncle lost $700,000 in the dot-com bubble. He was a very intelligent engineer, knew nothing about money. He was at the end of his career. His wife was an anesthesiologist. He just gave his money to an investor. The investor put it in a lot of this dot-com stuff. He lost $700,000 over in just a couple of months, pulled out of the stock market, swore he would never invest in stocks again. So he wasn't a very intelligent investor. So the NASDAQ is where a lot of the tech stocks resided at that time. A lot of the high growth tech stocks lost. I've heard different reports, somewhere between 80 and 88% of its value. I can't remember exactly what it was. It just dropped very, very low. Of course, it was up to about 5,000. Now it's 13,000. It's recovered. Over the long term, it's done okay. So I had some money in these stocks in my retirement portfolio, but I didn't pay any attention to it. There was a stock market crash in '88, stock market crash here, stock market crash here. I just put money in my whole career and haven't worried about it. So at the height of the dot-com bubble, I probably bought some stocks that were overpriced. After the dot-com bubble, I probably got some bargains on stocks. Didn't matter. Okay, right now I have a lot more money that's been put in over my whole teaching career. So that's really all I care about. A long-term plan can ride out any of these bubbles. It really won't affect you. The dot-com bubble, I know someone, actually my brother went to school with him. He sold his house and invested in a dot-com tech fund. Sold his house for probably $80,000 or $90,000. Lost almost all of his wealth. Probably lost 80 to 90% of the value of his house in the dot-com crash. He ended up moving into an apartment. He lost a lot. That happened to a lot of people. Lots of people invested right at the end of this euphoria period. You see all your neighbors getting rich. It's very difficult to avoid getting in. So if you if you invest between 3 and 4, you're probably going to lose a lot of money. That's just the way it is. It's a matter of basic psychology. Jeremy Grantham, he's a legendary investor. He and another gentleman named Carl Icahn, and also Jeffrey Gundlach. He's He's called the Bond King. He's from Amherst, actually. Uh, fairly influential investor. Those three people have predicted the great stock market crash of 2021. They said it could come as early as May. Uh, they haven't predicted like an exact date, like somebody that predicts the apocalypse. Jeremy Grantham has said as early as May, but he said, it could be 6 months from now, probably not years from now. He says everything in the stock market basically looks like we're down here somewhere between 4 and 5. And he also cites a lot of individual behavior, people doing crazy stuff. One example is Tesla. Like the value of Tesla stock is so high that, like, if you divide the number of cars they sell into the price of their stock, each car is worth like a couple of $1 million or something. It's just a crazy price. There's a lot of stocks out there where people have done crazy things. People are borrowing to invest in the stock market. Robinhood has everybody in the street gambling. There's a saying: when your shoeshine boy offers you a stock tip, it's time to get out. And I think the point is that when everybody is euphoric, everybody, and even your Aunt Sally, is euphoric about the stock market, and they're putting money into the latest investment. Well, we're probably down here. Okay, whether this happens or not, who knows? Watch the stock market. I'm sure if there's a stock market crash, you'll hear about it. I think we're due for, whether it's a crash or not, we're due for a big correction. I could see the market easily losing 30 to 40% of its value, possibly more, depending, by the end of this year. So, okay, that's bubbles. The best thing you want to do if you're a lifetime investor, like we've talked about, don't get carried away. Don't let this euphoria have you gambling with your money excessively. Nothing wrong with trying to time the market. Just don't do that with all your assets. Keep 5 or 10% of your money on the side. And try to time the market. Hey, it's a fun thing to do. You learn a lot. Watch the news. You can learn a lot about economics just by participating. It's just that it's very difficult. Over the long run, you'll do best just avoiding a lot of this. So if you pull your money out too early, you may end up missing a lot of growth. So, okay, that's it for this video.